Most Denver realtors will tell anyone with a pulse to buy a house, but I'm going to give you 5 tests to see if you're actually ready to buy, because I'd rather help you buy the right way than watch you struggle or fall out of contract 6 months from now. In this video, I'm going to be breaking down the 5 key readiness tests that every buyer should take before jumping into Denver's market. I'll walk you through what each test reveals, how to know if you're truly prepared, and what steps you could take if you're not there yet, so that you can buy with confidence instead of regret. I'm Landon, a local Denver realtor, and I've seen too many buyers get pushed into purchases that they weren't ready for. That 20% contract fallout rate that we're seeing, that's exactly what happens when people buy before they pass these tests. So before you even think about touring homes or calling a lender, let's start with test number 1. Okay, so buyer test number 1 is longevity. Are you planning on being committed to the area? Okay, are you thinking about staying for a while? Right? When we say a while, what does that mean? All right. During the pandemic, think back to when we grew 15% in our market in value for homes in 2020 and 18% in 2021, right? That means that in half of a year, you would have made more in the market than what it would cost you to sell. Okay, so 6 months is all you would have needed back then. We're not living in those times anymore, right? We're in a slow growth market. And so with that gradual growth that we're seeing right now, and Denver historically is more of a steady growth market, which is 5 to 7% per year. Right now, we're expecting 2 to 4% per year is what economists are expecting most of the time. So if that's the case, then, let's take the average, right? 3%. If we were to gain 3% per year, that's 9% in three years. That would put you at a pretty safe spot, considering that selling closing costs typically are around 6%. And buying closing costs typically are around 1 to 1.5%. Sometimes they can get paid for by the sellers, especially in this market, this time of year. But that's another consideration, right? So if you have 7.5% of costs involved, then you're making 9% after 3 years. You're probably in a safe spot to make a little bit of money after you sell in 3 years. So 3 to 5 years is that barometer. Say we're 5 years down the line, and the average of 3% per year, that's 15% in home equity. And you're gonna walk away with a good amount of money after that. If the average price in Denver is $633,000, multiply that by 15% gains. That's gonna be a pretty good number for you moving forward. And it'll put you in a spot where you're probably walking away with $30,000 to $50,000 after costs if you stay in the property for 5 years, which is well worth owning a home instead of renting a home. All right. So let's look at the opposite. Let's look at if you're not super committed to the area. Say you don't want to lay down roots. You don't feel comfortable with your life stage that you're in as far as income goes, job, quality or job certainty. And you're thinking that might jump around on you location wise. Okay? So if you're in that standpoint, the risk is you may lose out on a little bit of equity, a little bit of money on your house, right? The worst thing is selling a house and then having to come to closing to pay money for owning a home. I wouldn't want to put anybody in that standpoint. And if you only own the home for a year or two, then it may be putting you in a very difficult position where you can't sell that home for what you need to get out of it and cover your costs. And so your only option would be to either rent it out, and sometimes the numbers don't line up for it to rent and to make you money. Sometimes it's costing you money each month that you rent it. If your payment is, $3,000 a month and you can only rent it out for $2,500 a month, then it's costing you $500 plus maybe a property manager fee, plus maybe repairs on the house that come up, stuff like that, right? So all things that you need to consider if you have a shorter time frame approach to what you're thinking about doing. So 3 to 5 years is that barometer. If you pass test number 1, then we can move on to test number 2. If you're just not there yet as far as your commitment to the area, then it's wise to explore either investment properties if you do have a down payment saved up, but you just want something that can cash flow. Look at those opportunities, right? Or even an opportunity to renovate and sell a home. We've helped people make a lot of money with that approach. Or just consider waiting until your timeline becomes more clear. Now, even if your timeline is perfectly aligned, the next test reveals whether your finances can truly support a Denver home without constant stress. My next test would be, is your total monthly housing payment under 30% of your gross income? And so what components, make up the total housing payment? really it's more than just principal and interest, right? So principal is the amount that you're paying down on your principal balance. Interest is, the cost of borrowing money, right? It's what you're paying. And that interest rate that you get really determines how much of that you pay. Then you've got your other components of your mortgage. Typically, if you escrow taxes for property taxes and insurance, then you've got those things as well, right? That add to that monthly payment. And so all of that, we call that principal, interest, taxes, insurance, PITI. Okay. All of that should add up to 30% or less than your total household income. That's my recommendation. Okay. People that push this and go further can have some challenges, right? You become house poor. Sometimes you've heard that terminology. That's not fun, especially if you want to travel, you want to live a lifestyle, you want to eat out, you want to do fun things. The last thing you want is to be completely pinched, right? Based on having a home and then get into all kinds of consumer debt where you're paying 18 to 28% interest in other areas, right? So make sure that you know your budget and you understand, what that number is. 30% of your gross income would be a great number to stick with, all right? So with that, it's also important to understand the current home prices here in the Denver area. And so to help you with that, the average price of all homes in the Denver metro area, whether they're attached or detached right now, is $638,000. And with an average interest rate of 6.35%, that results in a monthly payment total of about $4,200. So keep that in mind, right? We want that to be 30% of your complete total household income. And so therefore, you'd need to make about $163,000 collectively in your household for that average price in our Denver market. Now, not everyone buys at the average price, right? Some people buy at half of that average price and buy a condo. And so you don't have to have $163,000 to buy a house. I want to be clear on that. Okay? In that case, if you were buying half of that, you'd need about $80,000 of total household income to be able to buy a condo right now. And then obviously the opposite is also true, right? If you're buying twice that, then you want twice that income. But making sure that the numbers add up, right? And you've actually thought through that so that you don't check your payment compared to your budget when you're under contract on a home and then have to back out later. You want to have ample funds for your daily life, for savings, for emergencies. Make sure that you're not putting yourself in a bind. Some people do stretch their budget to 40 to 50% of their income. And they adopt into that, I can afford it technically mindset, right? And it's all about the instant gratification type stuff instead of doing what's smart and what's financially responsible. And when you do that, when you take that approach, it often leads to being house poor. The other consequences to this are you struggle to handle surprise costs. You feel stressed every month. You have no money for essential home maintenance, or your overall lifestyle will definitely suffer during this. And so if you don't have any money for home upkeep and maintenance, then over time, it ends up weighing on the home. And when you go to resell, oftentimes that home looks run down, right? And so you'll make less money for the sale also, which also works against you. So having a cushion there, if you're 30% or less, then you have a cushion to make small updates to your home as time goes on. You can still live your lifestyle that you want to live, and you're ready for those surprise costs that will come up in the future. If you're not quite ready yet and you're not there, then I would suggest you explore neighborhoods where your budget works without stretching, or develop a plan to increase your income or down payment to afford the areas that you truly desire. Even if your monthly budget looks good, the next test reveals whether you have the upfront capital and financial cushion to truly secure your home and handle the unexpected. The next question is, how much cash available do you have for a down payment? And my suggestion is that you have at least 5% down, ready, plus 6 months of an emergency fund after closing. So if you have 6 months of savings for your average expense, then you're going to be in a spot where if something does come up, your water heater goes out, right? Your furnace goes out. You need a new roof. Something like that happens, you're ready for it, and you've got an emergency fund that you can deplete and then build back up. And 5% down is going to save you a lot on lending costs and higher cost loans. So I'll tell you a little bit more about what I'm talking about there. It used to be very common to do FHA financing, which is a government-backed loan with a minimum of 3.5% down. And there's VA loans as well with 0% down. and those can be good products too. I just want to make you aware of some of the fees and higher cost items in these lower down payment loans so that you're fully aware and you can understand and have clarity on some of this stuff, because I think it's important. So one thing that we need to talk about is private mortgage insurance. Okay? Private mortgage insurance, or PMI, is basically foreclosure insurance. It's like the bank's way of charging you more money to protect them for the money that they're lending you, just in case you don't make your payments and fall through. So the less money you put down, the more likely it is that you could fall into foreclosure because you have less of a cushion in your equity room. So when I say that private mortgage insurance is tiered, this is what I mean. Okay, if you're putting 20% more down on your home, then you don't need private mortgage insurance. The bank's confident that you're not going to get foreclosed on at that point. If you put 15% down, then you're charged anywhere from 0.3% all the way up to 0.65% of the loan amount annually. All right, so if you're borrowing $600,000 on your loan, then they can charge you that amount annually. And that's reflected in your monthly mortgage payment. If you put 10% down on a conventional loan, then you could pay anywhere between 0.35 at the lowest to 0.9% annually on your loan amount for private mortgage insurance. And then lastly, if you put 5% down on your loan, you pay anywhere from 0.55% all the way up to 1.3% of your loan amount annually. And those are all for conventional loans, right? Now let's talk about FHA loans. Okay, when you do an FHA loan, 0.55% is the private mortgage amount on an FHA loan. But what a lot of people don't realize is you pay 1.75% of the loan amount up front when you close, plus the 0.55% every month, based on the annual loan amount that you're borrowing on an FHA loan. And if you put 10% down or less on an FHA loan, then that mortgage insurance is lifetime. It never goes away as long as you hold the loan. If you pay more than 10% down, then the mortgage insurance will go away after 11 years. If you're doing a USDA loan, which is usually like a rural loan that you can do on like the outskirts of town in certain areas, it's geographically designated. Okay, those USDA loans are 1% upfront that's rolled into the loan amount for private mortgage insurance. And then after that, it's 0.35% annually on your loan amount. Last but not least, VA loans. Okay, the beauty of VA is that there's no private mortgage insurance. So I'm glad that they take care of our veterans in that way. What a lot of people don't understand is if you don't have a disability that in writing from the Veterans Administration, then you're charged a 2.15% upfront mortgage insurance premium when you purchase for your loan amount annually. And any subsequent purchase, if you use a VA loan again in the future, then it's 3.3% the next time. And so that upfront mortgage insurance premium is something that you should be aware of if you're doing a VA loan. And I know some veterans have chosen to do a conventional loan instead of VA at 20% down because it just makes more sense. There's less fees up front when you go that direction. So coming back to the point here, mortgage insurance premiums can cost you extra and just make your payment higher unnecessarily. And the lower your down payment, the more you pay on those typically. And so when you have 5% down and you can go conventional with your loan type, then you're paying a lesser amount. And you may ask, like, why was there a swing there between like 0.55% to 1.3%? The reason is because your credit is a big factor. You know, anything above a 680 credit score, you're going to get a way better rate on private mortgage insurance. 620 to 680 credit score, you're going to take that higher rate most of the time, and it's going to cost you more monthly. So having a strong credit score that's above 680 is going to help. And the higher it is, 720, 740, 760, there are tiers that will make your rate a little bit better. Not only your interest rate, but also your private mortgage insurance rate will be determined based on that if you have less than 20% down. All right, so if you're passing the test, you have 5% down payment saved for the purchase price that you desire, and you also have 6 months of emergency fund that's ready and remains intact after all the closing costs are settled on the purchase. This means that you can handle that $1,500 surprise expense without panic. If you're failing the test, you're scraping together only the minimum down payment, and your emergency fund would be wiped out by the closing costs of the purchase. And you're operating under the I'll save after I buy type of mindset. So if you're not ready yet, The roadmap to be ready on this item is to explore Denver's down payment assistance programs that you might qualify for. These would pay for up to 4% in grant money to give you part of that down payment that you could use. Okay, maybe a good idea to look at that anyways if the government's willing to give you some free money. But understand that if you do that, your mortgage insurance premiums and loan costs could be higher. And then the other key is increase your savings. For example, from like $15,000 to $50,000 within the next 12 months so that you have that cushion and you know that if something does come up that's unexpected, you're ready and well prepared for it. Having a solid down payment and emergency fund is critical. But existing financial commitments can also play a huge role in your home buying readiness, which brings us to the debt test. So lenders use something that's called a debt to income ratio to determine if a buyer is ready and qualified to purchase a home. And the way that lenders approach this is they look at your total income and then they subtract any debts that you have in your life, right? So monthly debts could be auto debts, medical debts, could be student loans, stuff like that, right? So that's subtracted from your income. And then they divide that by your total housing costs, right? So they'll take that number, income minus debt, and then divide it by what is your total housing cost in the year. And then you come up with your debt to income ratio. And so most, debt to income ratios that I recommend is staying under 43% total, right? So we talked about being at 30% housing costs based on your income, your gross income. And most people have about 10 to 13% of debt in their life, right? So if you can make it 43% debt to income ratio, that's usually the benchmark for where lenders for most types of loans don't have to get additional qualification or have a reason to qualify for you for more. They have ways to stretch with automated underwriting systems and basically based on this person has high income, it's just infrequent, or this person has a really high credit score, so we can go for a little bit higher debt to income ratio. So if they don't like the answers they're getting, they can look for justifications. But my recommendation is don't deal with those justifications. Like if you are 43% or lower, then you're in a great spot where you're not setting yourself up to be house poor most of the time. There are outliers to that, right? Like say you've got a business that's just started, it's producing really good revenue, but it can't be tracked yet because you don't have 2 years history in your work cycle. Then that may be something where, hey, you have the cash flow, but it just can't be justified or validated yet. And so it might make sense to go above that 43%. Understand, you guys, that lenders on conventional financing can justify going over 45 and go up to 50% debt to income ratio. So half of your net income, basically, they can use towards housing costs, and they can really stretch some people that way. You can also do up to 56.9% justification on your debt to income ratio on FHA loans if your credit score is right and you have the right income levels. And so lenders can stretch, you guys, but it doesn't mean that it's the right option and the right thing for you to go forward on if you're not truly ready and financially balanced enough to buy a home. So if you're passing the test, you're comfortably under the 43% debt to income ratio, giving you room to breathe financially and allowing you to handle a mortgage without sacrificing all of their financial goals that you have. If you're failing the test, then you're maxed out on other debts, pushing your DTI over 50% and operating with an I'll pay the debt later after I buy mindset. So the consequence of failing this portion of the test is that you may not get approved for enough to buy the home that you need. Or you might be approved, but find yourself financially drowning. A single job loss could lead to foreclosure. And so the roadmap, if you're not ready for this stage, is to identify and pay off specific high interest debts first, knock those out, and then the strategic approach can significantly improve your debt to income ratio, potentially qualifying you for $80,000 or more in mortgage funds and reducing your financial stress considerably. Even with your finances in order, buying a home in Denver requires more than just money. You need to understand the market itself, which brings us to our final and often overlooked test. So the core question here is, do you understand the current Denver market conditions and negotiation strategies? Right? And the reason why that matters is most buyers just put their head in the sand, right? They don't really look too much around and learn a whole lot about the buying process and about the market and what opportunities are out there. And the truth is, the more you know and the more you understand, the better you can just nail on the head what you really want and go get it. And it makes my job even easier too. When buyers are educated and they understand the market, then they understand that there may be a little bit of a dip in the transaction, right? During the inspection or during the appraisal or something like that. So you know what to expect as well, which really helps you have a better experience throughout the process. And so, the other reason why it matters is in 2025, 31% of Denver sellers are cutting their prices, right? That's $15,000 to $40,000 in concessions, right, that are available right now. You've got builder competition with rates below 4.75% in a lot of cases, and it also impacts that resale market. So without you digging into this knowledge, you're missing opportunities on the buy side and you're lacking awareness on the selling side as to what reality is in this market and what a buyer's actually willing to pay for a home, or what type of a discount you could get if you are a buyer. If you're here watching these videos and you've been with me for a while, watching for months, then you understand the current inventory levels. You're aware of builder incentives. You understand the recognition of negotiation leverage that buyers have in this market right now. And you're educated on specific Denver neighborhoods as well. Okay? If you're failing the test, then you've just started looking. Maybe this is the first video that you're watching, right? I would encourage you to go back and watch more. You may have no idea what's happening in the market, and you may be operating with an "I'll figure it out later" mindset, right? And haven't researched current trends. So I would encourage you to do that. But if you haven't done that, here's what could happen, right? You could likely overpay for a property. You could work with the wrong representative to help you that would misguide you. You could miss critical negotiation opportunities, and you may fail to ask for valuable concessions that can help you buy a rate down or help you cover all of your closing costs. And last but not least, you may buy a home in the wrong neighborhood for your needs and get enamored by upgrades where it's the wrong location for you. So there's a lot of things that can go wrong in the course of a real estate transaction. So it's super important, if you're not ready, right? Subscribe to my channel, watch specific videos on the Denver market conditions that I've put out there and will continue to put out. And then let's talk in 30 days when you're a little more educated and a little more confident in this market knowledge aspect of it. Now that we've taken the 5 tests, let's see what your results mean for your Denver home buying journey. So if you're looking at your sheet, taking notes, and you've got a 5 out of 5 on these tests, you're ready right now. Why aren't you calling me? Why haven't I heard from you yet? Definitely call the number on the screen. I would love to help you. This means that you're in an excellent position to now buy a house where you're not financially stretched and you can fully leverage current buyer advantages in the Denver market. And let's say you pass 3 or 4 out of the 5 tests. Okay, great job. That's awesome. All right, you're in a pretty good spot. So you're close. Your ideal timeline to get ready is within the next 6 to 12 months. And we can build a specific roadmap to address the remaining areas. Now, if you pass 1 to 2 out of the test, that's a good start. And usually, when I meet people that are in that stage, usually it's about a 12 to 18 month process in preparation. And this is perfectly acceptable. The goal is to start the process correctly and build a solid foundation rather than just rushing into this. And if you pass 0 out of 5, then you could be approximately 18 to 24 months away from being ready. So your focus should be on prioritizing the foundational steps first, then revisiting homeownership when you're in a little bit stronger position. And the overall goal for this scoring system is just to provide a clear, personalized roadmap and ensure that you approach homeownership strategically and confidently, avoiding the common pitfalls that most people go into. For those who passed all 5 tests, the Denver market currently offers some unique advantages that you absolutely need to know about. So here's some of the things that you should know if you passed all 5. The market currently favors ready buyers, offering very unique opportunities. Okay, with these price reductions that are happening in our market, 30% of sellers lowering their prices. That's amongst one of the highest rates in the nation right now, which is indicating a little bit of a shift in market dynamics here in Denver. Sellers are offering significant concessions, ranging from $15,000 all the way to $40,000 in upfront concessions and then again during the inspection. And that keeps deals from falling through for sellers, and they're motivated to do that to make sure they don't have to go back into this market. Also, expired listings. Okay, keep in mind that on New Year's Eve of last year, on that day, we had 821 expired listings. Okay, that's double the total amount from 22 and 23. So we have more opportunities that are coming back on the market that are trying again, right? And maybe very motivated sellers that just want to get their home sold. So that can create prime negotiation opportunities for very informed buyers. Also, buyers have great inspection leverage right now. Buyers have increased their leverage in inspections, and sellers are more willing to cave on repair requests that would have been dismissed completely or ignored in previous years. The other significant opportunity in this market is to target stale listings. What I mean by that is listings that have been on the market for over 30 days that have lost some of their maximum negotiation power. Sellers in those situations are often more motivated at that point, and they're looking to drop their price so that they can get the deal done. Also, builder incentives. Okay, this is an area that has huge opportunity. Okay, in a seller's market, builders don't offer anything to buyers. In fact, they're raising prices like every 2 weeks. They usually work off of their own best interest. But in this case, builders are offering all kinds of incentives to move property, and that looks like fixed low rates on top of buy downs, sometimes to buy down even a lower rate, offering closing costs to be paid for, and offering inclusions that aren't normal, like a refrigerator, a washer, a dryer, a backyard, fencing, blinds, all kinds of things that can be negotiated with builders right now that aren't normally even a topic of negotiation in most markets. So here's what you would do next. Okay, if you're a ready buyer, definitely book a buyer strategy call with me. Okay, and I'll show you which neighborhoods offer the best value, how to structure offers for maximum concessions, and how to win without overpaying in this market. Ignoring these market shifts means you'll miss out on substantial savings and favorable terms that currently exist. However, by understanding how to target stale listings, use inspection leverage, and counter with builder incentives, you can secure an incredible deal and truly thrive in your new Denver home. Now, if you didn't pass all the tests, there's no need to worry. You're simply not quite ready. And I have a clear roadmap to get you there. The first thing is don't panic. You're simply not ready yet, and that's perfectly fine. All right. So if the timeline is the failed test, let's clarify your actual timeline and housing goals to ensure your investment aligns with your life plans. And I'm happy to chat through that with you as well. Also, if it's budget, okay, I'll show you the neighborhoods that fit your current budget without stretching. You can always drive a little further to qualify, right? Or switch gears and take a little bit less house to be able to get into home ownership. So we can talk through that. Or we can build a plan to increase your down payment or income to afford your target areas. Okay, if down payment is the challenge or emergency fund is the challenge, explore Denver's down payment assistance programs, and I can help you through that. And we can create a 12-month savings plan to help you build your financial cushion. And I can connect you with great wealth advisors and just personalities that have written books or do a lot online to contribute to that. If it's debt, then identifying and paying off that specific debt first that's costing you the most is the key. And I can coach you through that as well. This will improve your debt to income ratio and potentially qualify you for more home if you can knock that out. And if it's number 5, market knowledge, just commit to watching my Denver market content for 30 to 60 days to build your understanding. And then when we reconnect, you'll know what's going on with this market. So the next step for you would be to just book a 15-minute roadmap call. And I'll show you exactly what to fix, how long it might take, and what the Denver market will likely look like when you're ready to buy. And I promise that it will be easier if you reach out to me early on, even if you've gotten 0 to 4 of these correct today. We can talk through it, and I can help and provide resources that will help get you there faster than if you just hold off and then call me once you've got 5 out of 5. Ultimately, the decision to buy a home is one of the biggest you'll ever make. So let's talk about the honest truth behind buying too early versus buying when you're truly prepared. So what I want you to understand is oftentimes buying too early destroys your finances. A stretched budget means no emergency fund, making your first repair a crisis. You feel stressed monthly, you're unable to enjoy home ownership, and you may even risk losing your house, right? And your lifestyle is not where you want it to be. Buying when ready builds wealth. A comfortable payment allows you to handle surprises, build equity without stress, and truly enjoy your home, making smart financial moves for your future. So my philosophy is that I would rather be the agent who helps you prepare for 12 months and then helps you buy a house that you love, rather than the agent who pushes you into something that ultimately ruins your finances. So the long-term impact is this. The difference between buying too early and buying when you're ready is literally hundreds of thousands of dollars over your lifetime. So my goal is to empower you to make confident, informed decisions that lead you to long-term financial stability and happiness in your Denver home. If these tests have clarified your path and you're ready to explore making Denver your home, I'd love to help. Relocating or buying a home is a significant step, and having a knowledgeable guide can make all the difference. My contact information is on the screen and in the description below. Call me or text me and let's chat about finding your perfect spot in Denver. Now, if you're still weighing your options or want to dive deeper into specific Denver neighborhoods, make sure you're subscribed and check out my next video right here, where I break down the best areas for families in Denver. Click on it and I'll see you there.